10 money habits that quietly make people rich in America. Most people think getting rich is about luck. They think it is about buying the perfect stock, starting a big company, winning the lottery, or suddenly making six figures overnight. But the truth is different. Most people who build real wealth do not do it loudly. They do not always look rich. They do not always drive the flashiest car. They do not always wear designer clothes. Many of them build wealth quietly, slowly, and consistently. And that is what I want to talk about today. My name is Edwin, and welcome to The Wealth Shift. On this channel, I talk about money, personal finance, credit, saving, investing, side hustles, and the habits that can help everyday people build a better financial future. In today's video, I'm going to share 10 money habits that quietly make people rich in America. I will count them down from number 10 to number 1. And I want you to pay close attention because some of these habits may look simple, but they can completely change your financial life over time. Let's begin. Number 10. I track my money before I try to grow it. The first habit is tracking money. I believe that before I can build wealth, I have to know where my money is going. A lot of people say, I do not make enough money. But when they check their bank statements, they realize they are losing money in small places every single week. It may not be one big expense. It may be $12 on fast food, $18 on delivery fees, $7 on coffee, $30 on subscriptions, $50 on random shopping, and $100 on things that did not really matter. Individually, those amounts look small, but together they can destroy a budget. For example, if I spend just $20 a day on things I did not plan for, that becomes $600 a month. In 1 year, that is $7,200. That is money that could have gone towards savings, debt payment, investing, or building a side hustle. So the first thing I do is not complicated. I look at my income. I look at my expenses. I check my bank app. I review my credit card statement. I ask myself, where is my money actually going? I do not track money to punish myself. I track money to understand myself. Because if I do not know where my money is going, I cannot control it. And if I cannot control it, I cannot grow it. Number 9. I stop upgrading my lifestyle every time my income goes up. The second habit is avoiding lifestyle inflation. Lifestyle inflation happens when I start earning more money, but I also start spending more money immediately. Maybe I get a raise and suddenly I want a better apartment. Maybe I get a bonus and suddenly I want a newer car. Maybe my business starts making more money and suddenly I feel like I deserve expensive clothes, expensive dinners, and expensive vacations. The problem is that if my lifestyle grows at the same speed as my income, I will always feel broke. There are people making $40,000 a year who are broke. And there are people making $150,000 a year who are also broke. Why? Because wealth is not only about how much I earn, it is also about how much I keep. For example, if I get a raise of $500 a month, I should not immediately add a $500 car payment. Instead, I can take part of that raise and put it towards savings, investing, or debt repayment. I can still enjoy some of the money, but I should not spend all of it. That is how I start building wealth quietly. I let my income go up, but I keep my lifestyle controlled. That gap between what I earn and what I spend is where wealth begins. Number 8. I build an emergency fund before life tests me. The third habit is building an emergency fund. An emergency fund is money I keep aside for unexpected problems. Because life does not ask for permission before it becomes expensive. A car can break down, rent can increase, a medical bill can come, a job can be lost, a family emergency can happen. And when I do not have emergency money, I may end up using credit cards, payday loans, or borrowing from people. That can create stress and debt. So I believe an emergency fund is not optional. It is protection. My first target does not have to be huge. I can start with $500. Then I can move to $1,000. After that, I can build 1 month of expenses, then 3 months, then maybe 6 months, depending on my situation. For example, if my basic monthly expenses are $3,000, then a 3-month emergency fund would be $9,000. That may sound like a lot, but I do not need to build it in one day. If I save $25 a week, that becomes $1,300 in 1 year. If I save $50 a week, that becomes $2,600 in 1 year. The point is to start. An emergency fund may not make me rich directly, but it stops me from going backward. And before I can build wealth, I have to protect myself from financial emergencies.
Number 7. I use credit like a tool, not like free money. In America, credit is very important. A credit score can affect car loans, mortgage rates, apartments, insurance, and sometimes even job-related financial checks. But the mistake many people make is treating credit like free money. A credit card limit is not extra income. If I have a $5,000 credit card limit, that does not mean I have $5,000 to spend. It means a bank is allowing me to borrow up to $5,000. And if I do not pay it back properly, I can be charged interest. That interest can become very expensive. So I use credit like a tool. I pay on time, I keep my balances low, I avoid maxing out credit cards. I do not buy things just because credit is available. For example, if I use a credit card for gas, groceries, or bills, I make sure I can pay it off. That way, I can build credit without falling into debt. The goal is not to fear credit. The goal is to respect it. Good credit can save me money because it can help me qualify for better interest rates. Bad credit can make life more expensive. So I remind myself that credit is not money. Credit is a financial reputation, and I want my reputation to be strong. Number 6. I attack high-interest debt before it attacks my future. Not all debt is the same. A mortgage can be different from a credit card. A student loan can be different from a payday loan. A business loan can be different from buying things I do not need. But high-interest debt is dangerous. Credit card debt, payday loans, and expensive personal loans can keep me trapped because the interest keeps growing. For example, if I owe $5,000 on a credit card and I only pay the minimum every month, I may feel like I am making progress, but the balance may barely move. That is because a large part of the payment may be going toward interest. So I need a debt plan. There are 2 common methods I can use. The first is the debt snowball method. This is where I pay off the smallest debt first. It gives me motivation because I can see quick progress. The second is the debt avalanche method. This is where I pay off the debt with the highest interest rate first. This can save me more money mathematically. Both methods can work. The best method is the one I will actually follow. If I want to build wealth, I cannot allow high-interest debt to quietly steal my future. Every dollar I pay in interest is a dollar I cannot save, invest, or use to improve my life. So I attack high-interest debt with focus. I stop adding new debt.
I make extra payments when I can. I track the balance. I celebrate progress. Because once that debt is gone, my money becomes mine again. Number 5. I automate my money so I do not depend on motivation. One of the biggest mistakes I can make is saying, I will save what is left. Because most of the time, nothing is left. Bills come, food costs money, gas costs money. Friends invite me out. Something breaks. A sale appears online. And before I know it, the money is gone. That is why I believe in paying myself first. When money comes in, I want part of it to move automatically. For example, every payday, I can set up automatic transfers. Some money goes to savings. Some money goes to investments. Some money goes to debt repayment. Some money goes to bills. Then I live on what remains. This is powerful because I do not have to wake up every day and feel motivated to save money. The system does it for me. If I can only start with $20 per paycheck, that is still a start. If I can do $50, even better. If I can do $100 or more, I will build momentum faster. The point is not the amount at first. The point is the habit. Automation makes wealth building boring, and boring is good. Because when wealth building becomes automatic, I do not need to argue with myself every month. I just let the system work.
Number 4. I focus on increasing my income, not only cutting expenses. Saving money is important, but I can only cut so much. I can cancel subscriptions. I can cook at home. I can reduce shopping. I can avoid unnecessary expenses. But there is a limit. At some point, I need to ask myself, how can I earn more? This is where skills become important. In America, skills can increase income. I can learn sales, coding, digital marketing, bookkeeping, project management, video editing, cybersecurity, trucking, real estate, AI tools, customer service, or business operations. I can also improve my communication, leadership, and negotiation skills. For example, if I earn $3,500 a month and I save $300, that is good. But if I learn a valuable skill and increase my income by $1,000 a month, I can move much faster. I can save more. I can invest more. I can pay off debt faster. I can build more options. So I do not only ask, how can I spend less? I also ask, how can I become more valuable? Maybe I need a certification. Maybe I need a better resume. Maybe I need to apply for a higher paying job. Maybe I need to start a side hustle. Maybe I need to sell a service online. Maybe I need to use my weekends differently. The point is that income growth matters. Cutting expenses can help me survive. Increasing income can help me expand. Number 3. I buy assets before I buy liabilities. A liability takes money out of my pocket. An asset has the potential to put money into my pocket or grow in value over time. A car payment is usually a liability. Expensive clothes are usually liabilities. Consumer debt is a liability. But investments, a profitable business, a valuable skill, or a good piece of income-producing equipment can become assets. The goal is not to never buy nice things. The goal is to buy things in the right order. If I buy liabilities first, I may look rich but feel broke. If I buy assets first, I may look normal for a while, but I can become financially stronger over time. For example, if I receive a $5,000 tax refund, I have choices. I can spend all of it on things that lose value quickly, or I can divide it wisely. Maybe I put some into emergency savings. Maybe I pay off debt. Maybe I invest some. Maybe I use part of it to learn a skill or start a small business. That decision can change my direction. Again, this does not mean I cannot enjoy money. I should enjoy life. But I should not sacrifice my future just to look successful today. Assets first, liabilities later. That is the order that can change everything.
Number 2, I let compound interest work for me. Early compound interest means my money earns money, and then that money can also earn money. At first, it may look slow, but over time, it can become powerful. That is why starting early matters. For example, if I invest a small amount every month for many years, the growth may not look exciting in the beginning, but after 10, 20, or 30 years, the results can become much bigger because time is doing part of the work. This is why I should not wait until I am rich to invest. Many people think, I will start investing when I have a lot of money. But sometimes the habit of starting small is more important than waiting for the perfect amount. If I can invest $25, I start learning. If I can invest $50, I build consistency. If I can invest $100, I build momentum. Of course, I should understand what I am investing in. I should not invest blindly. I should learn about risk, fees, taxes, retirement accounts, index funds, and long-term investing. But I should not ignore the power of time. Saving protects my money. Investing can grow my money. And compound interest rewards patience. The earlier I start, the more time I give my money to work.
Number 1, I become patient enough to look boring. The final habit is patience. This may be the most important habit of all, because building real wealth can look boring. It may look like driving the same car for years. It may look like cooking at home instead of eating out every day. It may look like wearing normal clothes while other people are trying to impress strangers. It may look like investing quietly every month. It may look like checking my budget. It may look like saying no to things I cannot afford. It may look like working on skills while other people are scrolling. And that is not always exciting, but that is how wealth is often built. The internet makes everyone feel behind. Every day, I can see people with luxury cars, expensive vacations, big houses, and perfect lifestyles. But I have to remember that I do not know the full story. I do not know their debt. I do not know their payments. I do not know their stress. I do not know whether they own it or borrowed it. So I cannot build my financial life by comparing myself to someone else's highlight reel. My goal is not to look rich. My goal is to become financially free. That means I have to be patient. I have to be consistent. I have to make smart decisions even when nobody is watching. Because real wealth is not built by one big decision. It is built by repeated decisions. The quiet decision to save. The quiet decision to invest. The quiet decision to pay debt. The quiet decision to improve my credit. The quiet decision to learn a new skill. The quiet decision to avoid wasting money just to impress people. That is the real wealth shift. So let me recap the 10 money habits that quietly make people rich in America. Number 10. I track my money before I try to grow it. Number 9. I stop upgrading my lifestyle every time my income goes up. Number 8. I build an emergency fund before life tests me. Number 7. I use credit like a tool, not like free money. Number 6. I attack high-interest debt before it attacks my future. Number 5. I automate my money so I do not depend on motivation. Number 4. I focus on increasing my income, not only cutting expenses. Number 3. I buy assets before I buy liabilities. Number 2. I let compound interest work for me early. Number 1. I become patient enough to look boring. If you are watching this and you feel behind, I want you to know that you can start from where you are. You do not need to be perfect. You do not need to be rich already. You do not need to understand everything today. You just need to start making better money decisions one step at a time. My name is Edwin, and this is The Wealth Shift. Subscribe to the channel if you want to learn more about money, wealth building, credit, investing, saving, side hustles, and financial habits that can change your future.
And before you leave, comment below and tell me which habit you are going to start with first.